GQ Conversations. This is ongoing set of conversations with some of the top equity managers in the country about what is the churn that they've seen or what is the churn that they have enacted in their schemes to better manage returns over the course of the next 12 to 24 odd months. Surely the portfolio currently is different from what it would have been 9 to 12 to 18 months ago. In that conversation today, we have with us Harsha Upadhyaya of Kotak AMC. Needs no introduction. Harsha, great having you. Thanks for joining in.
Thanks, Neeraj. Pleasure talking to you.
So, Harsha, has there been a big change of sorts in either the components or the percentile of some of the major components in the portfolio compared to what would have been 9 to 12 months ago?
Yes, it's an ongoing process, Neeraj. And clearly, if you step back and see where we were 9, 12 months back, we were envisaging clearly higher interest rates led by commodity inflation, which was just starting to show its heads up. And that's when we started to look at sectors which would have given us a better insulation from the drag, whatever we could see from the volatility that was expected in the market. And also, we were very conscious of the fact that while commodity inflation is a problem for corporate profitability and economy as well, there will be segments which will do better even in that scenario. Is what we were looking at. And that's where we wanted to increase our positions. And also, we were pretty clear that domestic growth is going to be more resilient than global growth, and which has actually panned out. And even as you look forward, I think that's going to be the case. That is when we started to reduce our weightage in IT sector, for example, especially from the mid-cap IT, fearing that one, the valuations were anyways above normal in that particular sector at that point of time. And also given the fact that higher interest rates have a negative relationship or an inverse relationship with equity valuations. And given the fact that global growth is going to be a little skewed on the downside, we felt that it's better to tilt our portfolios towards domestic businesses rather than being in IT, for example. So we went and booked profits across mid-cap IT companies and many of the even larger names during that period, and moved that weight and also the incremental flows that we got into some of the businesses which were domestic facing and which were also cyclical. While one could say that why bet on cyclical when there were so many issues, our thought was if you look at some of the defensive sectors of our economy, for example, FMCG, it was quite richly valued at this point of time. And also it was facing similar headwinds of commodity price inflation as many of the other domestic segments. But we felt that in segments such as banking, auto, industrials, and many of the other domestic segments, at least there was a possibility of re-rating as and when the commodity inflation would start to subside or whenever the first indications would happen. And also we felt that given our resilient economic growth, these were the some sectors which would possibly give you a chance of re-rating rather than worrying about what is going to immediately happen in terms of prospects of that particular sector. That is when we shifted our allocation from, let's say, IT or some of the other export-oriented businesses towards domestic sectors such as banking, auto, industrials, and many such sectors.
I heard you say in the opening answer that stance likely will remain because that is what would do well. So the drop in the valuations, let's say, for example, in IT, is not tempting you to try and relook at that space?
Neeraj, we may have added a little bit of IT when the stocks have fallen in the recent times, but still it's an underweight sector. We believe that on a relative basis, again, the chance of re-rating is much higher in some of the domestic sectors rather than IT sector. That's one. And secondly, if you look at the commentary from IT companies during the previous quarter results, most of the commentary indicates that the business is going to be relatively weaker this quarter and maybe even going forward. Definitely the furloughs in this quarter are likely to be higher than what previously we would have seen in this particular quarter. And all in all, 2023 is still going to be choppy from a global macro perspective, which means that wherever there is discretionary IT spend, the businesses would take time to evaluate that, or would probably focus more on the payback period and how that's going to impact their profitability in the short term, etc. So either there will be some cut in discretionary IT spend, according to our view, or there could be delays in terms of concluding some of the larger deals, both of which mean that the business momentum is likely to be weaker compared to some of the businesses which are more determined by how domestic growth pans out next year.
Yeah, that's a pertinent point. Okay, in the answer that you just gave us, you told us that there is a probability that some of the domestic sectors stand a chance of re-rating. Now, with the markets being at the levels that they are, and with the non-export oriented names not quite down in the dumps. I mean, when I was looking at a list of stocks which are substantially lower from the previous highs, and that list is dominated by IT platform companies, spec chem, commodities, etc. The domestic oriented names are kind of doing reasonably okay. So where do you see chances of re-rating, Harsha? Or where is it that your thesis is that this is where the re-rating would happen?
We believe that investment cycle is finally picking up. While people may say that this has been one of the expectations for last 10 years, and every now and then we have had these expectations and it has not panned out, while I would agree on that assessment. But 3 points to talk about on that issue. One, is there a need for higher capacities in the country? And I'm sure everyone would agree that there are really gaps in capacities across many sectors. And we have seen many of those manufacturing sectors already announcing some capacity expansion as well. And clearly, for the 10 years or 12 years after global financial crisis, we really have not seen many of these sectors increasing their capacity, and the excess capacities that were there earlier or which got created due to fall in demand during COVID disruption. I think all of those are things of the past, and clearly we expect capacity expansions to take place. May not be immediately, but going forward from here, I think we should be looking at more announcements and more implementation of that front. The second factor is there a borrowing ability or to fund that growth from the corporates? I think if even despite the COVID disruption, the balance sheets across the board, even if you look at the leverage sectors, which are generally leveraged, for example, power, infra, metals, etc., the corporate balance sheets have really, really improved. And there is enough and more in terms of the ammunition for some of these corporates to actually go ahead with their growth plans. Not only their internal accruals are strong as you look forward, the balance sheet deleveraging has also taken place. So, in case there is a need for borrowing money, I think that's also possible. So, the second point is there is ability from corporates to borrow money to fund the corporate expansion plans that you could see. The third is in the past, we didn't see real pickup or a continuation in the investment cycle because the ability to fund those projects was also kind of disrupted due to many factors. For example, our financial system had seen real estate sector bringing in a lot of pain. There were asset quality issues on most of the banking balance sheets. We had also seen a crisis in the NBFC sector. So the lending ability was also kind of curtailed. Now, when you look at the health of banks, for example, I think clearly the asset quality issues are more there. And the corporate health as well as the banking sector health, both are in good shape. That's the third point that I wanted to say. So finally, the investment cycle should pick up reasonably well from here on. And all the other components which aid investment cycle also seem to be in place. So anything that is related to investment cycle, starting from the credit growth improvement, which will help financial sector, even the sectors such as industrials, capital goods, which anyways will see better order book and better execution as you go forward. And also some of the names where you would see capacity expansion happening with internal accruals and not much of leverage, which could disproportionately improve their profitability going forward, will be some of the areas to look at. And that's the reason why we have been betting on, let's say, banking, industrials, cap goods, etc. And within banking, we believe that as interest rates have been going up, while credit growth remains strong, there will be pressure on margins. And that's where we have preferred some of the larger names within the banking sector, where we believe that the ability to get low cost funds is much higher as compared to, let's say, some of the NBFCs or even the smaller banks. That's how we have positioned ourselves across many of our portfolios.
And probably explains how why some of the best NBFCs in the last 2 months haven't done well, but some of the banks have certainly piled on the gains. Thanks for that explanation, Asha. Great to understand that thought process. The final question really on is around some of those dark horses that are starting to come up, right? And I just wonder, as a mutual fund, as a large mutual fund, do you take some meaningful positions there? So, for example, I mean, I'm just illustrating. There is defense, which is come of age. Order books are bulging, and company conversations are strong. This morning, we got this newspaper announcement, or rather, the newspaper article about how so many firms have bid for 200 Vande Bharat trains, and which includes a bunch of domestic players. And railways is becoming a fairly large opportunity, if you will, as well. Add to that the whole biofuels movement that happened in green hydrogen, while there's no direct way to play it, maybe, but that is coming up. So, in any of these emerging themes, so to say, in the last 12 months, is there a large opportunity which you've been tempted to take or have taken?
We have definitely taken defense manufacturing as one of the core components of our portfolio, in many of our portfolios. And this has been there in our portfolios for last several years. And clearly, we have been seeing improvement not only in terms of the order intake, but also the kind of indigenization efforts that are happening in the defense sector. I think we'll keep helping some of these defense manufacturers. While the valuations are no more as attractive as what it used to be a couple of years back when we had entered, but we still believe that there is a large runway for growth in this segment and continue to hold some of those names. As far as railways related investments are concerned, we are playing it through various sub-segments. It could be some of the ancillary business that help railways, or the direct investments which happen into railways, etc. But compared to defense, I think our positioning vis-a-vis some of the investments that are happening in the railways and the beneficiaries over there would be lesser. But we do have some of the bets in our portfolios. And these two segments, while the valuations may have gone up because there has been a very, very strong news flow in the recent past, and some of the developments have been really positive. But from a opportunity size and the runway for growth that is there, I think clearly this can be a multi-year runway for growth. So it makes sense to look at this, but obviously the valuations have not been as low as what they used to be. But you will have to factor in the fact, the point that the growth can be quite strong for next several years. And if you take that into account, maybe keeping some of this in the portfolio even now or entering afresh may not be a bad idea.
Last question, Asha. When do you change your thesis on the export-oriented themes? Is it a valuation factor, or is it a proof of business turning? What would it take?
I think at some point of time in the near future, you will start to see Fed pivoting in terms of interest rate movements. And thereafter, we need to see whether growth would subside. Because initially, when it pivots, maybe there will be a knee-jerk positive reaction and some of these names would go up. But they would be pivoting only because they fear that the macro environment is not strong for sustenance of growth, right? So I don't think that will be the first entry point that will give you great returns. Maybe tactically it will give, but only when you see global growth kind of stabilizing and some of these macro issues getting better, then I think you would probably take a much longer term expectations into account and position yourself in some of those sectors. But every now and then you may find some of the valuations in some of those names being attractive. Maybe you would want to build some position at various points of time. But I think to go a big overweight on the export oriented names, maybe you will have to wait and see how global macro develops and how it stabilizes. I think that's when you will be able to take a larger bet on those things.
Got it. Harsha, great talking to you as always. Thanks so much for sharing the time today, and look forward to having more often.
Thank you, Neeraj. Thanks.
Pleasure was ours. Viewers, thanks for tuning in.